Hi, everybody. This is Jeff Horton, and welcome to the Mortgage Minute. We'll try to get to some of the information that was out today about inflation. The inflation has come down a bit, but should we be cheering? No, we should not. You know, it's interesting. When we talk about inflation, when we talk about economic issues, there's always a political side, and I hate that particular part of it just because, it's not a cheering section. 8.5% inflation rate is terrible. Most people suffering from that are in the lower income brackets, and those people really need help. And help in the form of obviously lower inflation. And what the Fed or what the government is doing about it is little. And so, therefore, those people suffering, it's a rough go for them. So let's not forget that as we talk about what is or what is not good news. Yes, it is good news that inflation is trending down. No, it's not good news that it's 8.5%. And also, it's probably more so for food and for other items that people use and need every day. Gasoline being one of them, even though gas has come down for a number of days in a row. It's still too high, and it's still too high for people who need to get out and drive around and make a living in their car. Let's get to some other facts here. The interest rates today, 30-year fixed rate is at 5.13. The 15 years at 4.52. 4.60 is the FHA, 4.65 is the jumbo, and 5.45% is the 5/1 ARM. Now, it was asked of me, why is the ARM product, which is really shorter term and a bit more risky for the borrower, so much more expensive than a 30-year fixed? Well, the ARM products are tied to the 2-year bond. The 30-year fixed is tied to the 10-year bond. So if you notice the price and the divergence in those two particular bonds, the 10-year and the 2-year are now inversely spread, so that the 2-year is actually making more money if you invest in the 2-year than the 10-year. And that's antithetical to what we would consider a normal market, and usually portends not inflation, but an economic downturn in the form of a recession coming on the horizon. But anyway, that was the explanation given to me. And again, the 10 years at 2.75 and the 2 years at 3.162. You can see the spread there is between 30 and 50 basis points, has been for the last 2.5-3 weeks. It's something to continue to keep a watch on. And if you're looking for an ARM product, just know that the 2 years, the bond you have to look to. Loan Depot exits wholesale. There's been a number of different things happening in the lending world. If you're wanting rates to go lower and you're trying to get the loan that you want to get, it is important to see that the industry itself is suffering, a really bad time right now. I mean, we're having originations down by, anywhere from 40 to 70%, depending on the lender. Some lenders are out of business. We had, who was it? It wasn't Orion. It was anyway. Loan Depot today announced that they're getting out of the wholesale business. Actually, I can't remember that other one. I didn't write it down. They're out of the correspondent business, and a number of other banks as well as lenders have laid off anywhere from 400 or 500 to a few thousand people in their origination sector. Again, originations are down between 40 and 70%, depending on what area and what part of the country you're in. I had written down here some 5 points to look at if you're looking to see whether the economy is in a recession. And all of this is important to you if you're going to buy a house, obviously, or if you're going to get a mortgage, either a refinance or a purchase mortgage. And the reason that is because as the economy goes, a lot of times so goes the mortgage rates. So there's 6 of these things to look for. Unemployment rate is one of them. We've seen 3.5% be the unemployment rate, and we've seen some of that called into question. Just remember that the jobs available fell from 11.9 million at its high to 10.7 million. Now, that's a lot of jobs. It's about 2 jobs for every opening, but the fact that it's falling is a leading indicator of where we may be headed in terms of employment in the next few months. Fed raising rates, yeah, that's important too. Taking money out of the system, and that's important if we want to have inflation get under control. The inverted yield curve, talked a little bit about that. overheating of the economic sector. Once demand is met, layoffs will happen. What that means is that we've got overexuberance, as Greenspan used to, not Greenspan, but yeah, maybe it was Greenspan used to say when it came to how the market was reacting to certain things. Overexuberance simply means that there's a lot of people looking for a certain product. When that product is delivered to those people, the demand is satisfied, and therefore the prices go down, and that's what they're looking for as well. New home sales, housing starts, and permits, all off, all fall into a recession, according to some of the articles I read. And the last one, leading economic indicator, the LEI, declines 4 to 6 months before recession. It's something to look for. Anyway, it's 5.5 minutes. Gotta go. It's Jeff Barton. This is the Mortgage Minute. We'll see you next time.